In Chapter 12, we're going to look at what we call the statement of cash flows. We've talked about this briefly as we've gone through the course, but now we're actually going to study what all makes up the statement of cash flows, what goes into it, and then how to create it. So the first thing is what is the statement of cash flows? It's simply a statement that tells us how we have spent our cash. So what money has come in, or what cash has come in, what cash has gone out. And the bottom line is that it explains the change in the cash balance. And what I mean there is, let's say that we're putting together the statement of cash flows for the year 2015. What the statement of cash flows is going to do is it's going to say we started the year 2015 with a specific balance in our cash account of, say, $100,000. So that means at the end of 2014, we had $100,000. Now at the end of 2015, let's say our balance sheet says that our cash account has $150,000. Well, the statement of cash flows is going to show us that change. Where did that extra $50,000 come from? And it's going to explain that to us. So we've already mentioned what the statement of cash flows does, and along with that, we already understand that it explains the cash coming in, the cash going out, and then the overall change in the cash balance. But what's also important about the statement of cash flows is it explains to us why our income amount differs from our actual cash. Oftentimes students get a cash flow statement confused with an income statement. But remember, we have been studying GAAP accounting. And with GAAP accounting, we are following the rules of accrual accounting. So sometimes we may recognize income before we actually get the cash. And so in that case, our income statement and our cash flow statement would differ. On the other hand, based on our various accrual rules, sometimes we may recognize an expense before we've actually paid the cash for that particular expense. So then again, that's just a difference between our statement of cash flows and our income. So by understanding the statement of cash flows and what all it's telling us, it's going to give us a picture of why our income and our cash flows are different. So when we're looking at the statement of cash flows, we are looking at the change in cash. But we're also lumping in there what we call our cash equivalents. So cash equivalents are just typically those short-term and highly liquid investments. They're investments that are readily convertible to cash. All you have to do is maybe take your certificate of deposit to the bank or your bond and ask for the cash in exchange for that. And it's sufficiently close to the maturity date so that we don't have any change in the actual cash value due to changes in the overall market. So again, this is the statement of cash flows, but we're also looking at our cash equivalents. So when we do a statement of cash flows, we're going to have three different sections. And these three different sections are our classifications for where we have either spent or brought in money. So the three main sections are the operating activities, investing activities, and financing activities. What these are is we're lumping them into various related activities. So, for example, our operating activities are going to include all of the activities that surround our company's basic operations. So whether we're dealing with suppliers, maybe we're buying something from our various suppliers or paying for those supplies, whether we're bringing in money from our customers, things like that. Those are our basic operations. Then investing. Investing is anywhere where we are investing our money. So that could be a capital investment. Maybe we're purchasing some type of new building or plant or some type of equipment. We're investing our money maybe in some type of long-term money type investment. So these are investing when we are investing money and hoping to see a return on that. And then finally we have our financing activities. When we talk about financing activities, we're looking at where are we getting our money from. So this could include borrowing money from a bank, so your various notes payable, or it could be equity type transactions with the owners of your company. So we're going to look at all of these very carefully and all of the specific items that go into these classifications, but just so you first have a basic understanding of what those classifications are. So we're going to begin by really looking at our operating activities. And if you'll remember, these are the activities where we either spend money or bring money in related to the basic operations of our company. So let's look. Cash inflows would be cash coming in from our sales with our customers. Making sales to our customers is one of the basic operations of a company, so it's part of our operating activities. Collections from credit sales, that's another typical operating activity. And then we have 3 items that sometimes students seem to think that these should go more in the investing section, but I'm going to go ahead and tell you that they are not part of investments, so this is something that you actually need to memorize, that these are part of operations. So any money that you receive from dividends. So if you have invested in another company, you own stock in another company, that's fine, that would be an investment in another company. But if you receive dividends from that investment, the actual dividends are going to be part of our operating activities. Then let's look at, what if we have some type of sale from trading securities? Again, oftentimes people want to say that this would be an investment because typically your securities are a type of investment. But a trading security is something that's so close to cash, it's not a true investment, long-term type investment. So if we're selling and bringing in some type of gain from the sale of these trading securities, that cash coming in is going to be part of our operations. And then also here, if we receive any type of interest revenue, meaning we have loaned someone some type of money, the receipt of interest from that loan is going to be an operating activity. Don't confuse that with an investing activity. That is going to be an operating activity. Because loaning money to maybe the president or the CFO of your company, loaning that money is not a true investment. Like if you were going to go invest your money in some type of stock or certificate of deposit of some sort, those are investments where you're hoping to see your money grow. But if you have some type of basic loan to a person or another business, that's not a true investment. You're loaning that money to help out the president of your company for some reason, or the CFO of your company, or maybe you have a particular customer who needed a loan to continue doing their business, and rather than losing that customer, you loaned money to them. Or if they had some type of account payable that they weren't able to pay on, so you transferred it to a more formalized note payable, and then you're earning interest from that. Again, that's just part of your basic operations of a company. This is not an investment, so any type of interest revenue coming in related to that is going to go here in your operating activities. So then let's look at some of our cash outflows related to operations. Paying any type of wages or salaries, paying our basic operating expenses, whether that's rent or utilities, things like that, paying our suppliers, and then also paying taxes or fines. Again, taxes and fines, these are the basic operations of your company. You cannot have a company without paying your taxes. So that's just part of your basic operations. And then again, like we were talking about some of these things that look like they could be confused with investing activities, but they are actually operating activities. We also have some outflows. So if we're paying any kind of interest that we owe, that is an operating activity because the interest is part of our operations. It's part of operating as a company. As time passes, if we have money that we have borrowed, the interest is accruing just based on the passage of time, and that's going to be an operating activity. And then if we are using our cash to buy trading securities, again, notice we're talking about just the trading securities or those very short-term type of securities. That's part of our operating activities. Now we're going to move into investing activities. And if we're investing our money, we are buying something or investing our money in some type of investment in order to see a return on that money. So the cash inflows that we might see are if we sell property, plant, and equipment. So that would be an investment because when you bought these items, these were investments in the company. You're investing in the future of your company. So then when you sell them, that's also going to be part of our investing activities. If we sell long-term investments would be investing activities. So when we sell those and the cash that comes in, that's going to be a cash inflow. If we sell short-term investments, the cash coming in is also going to be an investing activity. But notice we say except trading securities. So trading securities, again, remember those are so short-term. Those are going to be lumped in with our operating activities. If we sell or discount notes receivable, so notes receivable are going to be part of our investing. But remember, again, any interest related as part of that operating activities. If we sell intangible assets, that's part of an investment. And if we collect on the principal of a note receivable, that's also investing. Again, notice we're saying the principal of it. We're not collecting the interest here. The interest is part of our operations, but collecting on the principal is part of our investing activities. So then what are the cash flows related to investments? When we buy property, plant, and equipment, we buy intangible assets. If we buy long-term investments, if we're buying short-term investments, again, except trading securities. And then if we're loaning money in return for a note receivable, all of these are cash outflows related to investing activities. Finally, we're going to look at our financing activities. And financing activities are, again, these are the activities that help us to finance what's going on in our business. So this is where we're bringing in money from some type of outside source. It's not from the operations of our company, but it's coming in from either a loan or some type of outside investor. So here, if we issue common and preferred stock, that's one of the most basic types of places that you get your financing. So that's a financing activity. If we're issuing short and long-term debt, so if we're going to a bank and borrowing money, whether it's short-term or long-term, that's a type of financing activity. Contributions by our owners. So this is we already have stockholders or owners in a company, and they're making additional contributions. Those are all financing activities. If we reissue treasury stock, the reissuing of treasury stock is again a financing activity because we had purchased this stock out of the stock market, we held it in our treasury, and then when we sell it again, we're selling it back out onto the market and we're getting cash for that. So that's going to be a cash flow related to stock activities. So again, anything related with stock, contributed capital, or taking in a loan are financing activities. It's we are financing our business. So then our cash outflows are if we purchase treasury stock, if we pay dividends to our shareholders, pay off any type of our debt, whether it's short-term or long-term, or if we pay withdrawals by our owners. And then I just want to mention one other type of transaction that we need to include in our statement of cash flows. But what's important here is that these are non-cash activities. So they're not going to actually go in the actual statement of cash flows, but they're important transactions because they're large, and we'll talk about what I'm looking at. But these are either going to go as a note in the notes to your financial statements, or you could add a note to the bottom of your statement of cash flows, but they're not actually going to be part of the actual numbers in the statement of cash flows. So what am I talking about? These are transactions that are non-cash type transactions, and they're generally involving investing and financing activities. So let's think about this. This is where we are purchasing something or paying something back, but we're not doing it with cash. Instead, we're financing these transactions. So there's actually no cash changing hands. So that's why these are called non-cash transactions, but they're generally large transactions. So we still want to disclose them because they're going to have cash effects at some point in the future. So let's look at this. If we are retiring debt, that means we are paying off something that we owed. Typically, you retire debt with what? You pay it back with cash. But if instead of paying it back with cash, we issue equity stock, we're paying off our debt, so we're reducing our liability, but we're issuing stock. So we're having a non-cash transaction. Another example is if we're converting preferred stock to common stock. If we lease assets in a capital lease transaction, this would be if we're leasing or renting an asset rather than paying for it with cash. If we purchase a long-term asset, instead of leasing it, we're actually purchasing it, but we're not paying cash. We're issuing a note or some type of bond. We're issuing a liability. Again, we're getting an asset, but there's no cash changing hands. This is typically a large and important type of purchase. And just because cash isn't changing hands doesn't mean we ignore it. Instead, we need to disclose it. And we've got a couple other examples here. But the bottom line is that these are non-cash investing and financing activities. And they are non-cash, so they're not naturally going to show up on the statement of cash flows, but we still want to disclose them. So now let's actually get into the statement of cash flows. As we go over the next couple of slides, we're going to introduce the fact that there are two basic ways of preparing your statement of cash flows, the direct method and the indirect method. I'll go ahead and tell you that the direct method is typically a more simplistic way to prepare the statement of cash flows, but what we're going to concentrate on is the indirect method, which a lot of students do think is a little bit more complex. Now, why are we concentrating on the more complex of these two? Is it just because we want to make the class difficult? No, that's not at all true. The reason that we concentrate on the indirect method is because based on GAAP, which is the Generally Accepted Accounting Principles, and the SEC and the FASB, if a company chooses to use the direct method, they also have to do the indirect method. So most companies simply skip the direct method. They're not going to prepare it two ways, and they just go straight to the indirect method. And we'll look at why that is. But the indirect method gives us more information. And what the indirect method does is it shows us what our net income is, and then it helps us to see the difference between our cash coming in or our cash going out and our net income or our net loss. So it helps reconcile the difference between our income and the cash that has actually changed hands. So it gives us more information. But before we get into direct versus indirect method, let's first look at the overall setup of the statement of cash flows. You can see here we start with the company's name, tell everyone this is the statement of cash flows, and for whatever period that we're working on. So we'll begin with the first section is going to be the cash flows from operations. Then we'll have cash flows from investing activities, cash flows from financing activities, and then we have our overall increase or decrease in cash, and that's just a sum of the cash flows from our various activities. Then what we want to do is take this net change in cash and make sure that it proves the difference between the cash we began the period with and what we ended the period with. If this amount here, the change in cash from our statement of cash flows, does not explain the change in the balance of our cash account over the year, that means we've probably missed something or done something incorrect. So this is a good way to check your work. Now, when we move forward and begin talking about the direct versus the indirect method, that's only going to affect this first section, the cash flows from operations. It's not going to affect how we do our investing or financing activities. It's only going to be a choice in how we calculate the cash flows from our operations. So again, to prepare the statement of cash flows, we first will compute the net increase or decrease in the cash, compute the change in operations, investing, and financing activities, and then we want to prove that our statement of cash flows fully explains this change in our change in the cash balance over the year. So let's look at how we actually can go about this. First, the most obvious place is to begin looking at what happened in the actual cash account. So this is what you would typically do if you're using the direct method. You're going to be looking at what happened in this cash account, And you'll be pulling out all of the things and categorizing them as to whether they are operating, investing, or financing type activities. So you would go through each of these. It's fairly straightforward. But then if we're using the indirect method, we're going to be taking a more holistic view of what happened at the company. And what the bottom line is we are looking at all transactions and looking at how they ended up affecting cash. And we do that by understanding how it affected our overall accounting equation. So let's look at this. We can break each of these into, for example, assets makes up cash plus non-cash assets equals liabilities plus equity. If we leave only cash on one side of the equation, that means we still have liabilities plus equity, but to get our non-cash assets to the other side, we had to subtract them. So what this tells us is that any type of change in the cash account is going to have an equal effect in our non-cash accounts. So what you're going to see here is if a liability increases, we'll also see that change in the cash account. So if a liability increases, that means that you owed someone money, but you did not pay them cash. So we're going to see that equal effect as a change in the cash account. Then let's talk about non-cash assets. Let's say that we purchased property, plant, and equipment. If we purchased it, this non-cash asset is going to increase, and we paid with it for what? For cash. So that just gives us an idea of how these things move. So to prepare the statement of cash flows, you're going to need comparative balance sheets, meaning you need to see the change in your various accounts from year to year. And we're talking about not just the cash account, but all of our accounts. So for example, you'd want to see how did accounts receivable change. So you may be thinking, well, how does accounts receivable affect cash? So let's think about this. If we made revenue, you either get cash or you get an account receivable. If we're doing the indirect method, we are going to be starting with our net income and adjusting our net income for anything that we didn't get cash for. So if our accounts receivable increased, that means we made revenue. So that revenue is going to be reflected up in that net income number. But if our accounts receivable increased, that means we did not get cash for that revenue. So therefore, we need to decrease our statement of cash flows for an increase in accounts receivable. It seems complicated, but once you kind of get the flow of things, and we've got a cheat sheet that we'll look at in a couple slides, it really helps you understand how this works. We'll need the current income statement because we need that net income number. And we'll also need some other information on here, and that's going to be non-cash type items that are in our income statement number. So for example, if we had any type of amortization, depreciation, those are things that decrease our net income, but they're not actually cash transactions, so we'll need to make adjustments for that, and we'll look at that when we actually get into preparing an example. And then we'll need some additional information as we move forward. So here are our basic two methods. We have the direct method and the indirect method. And remember, this is only going to differ in our operating activities section. So you can see here, this is just a snapshot from a statement of cash flows. Up here is the direct method, down here is the indirect method, and you'll notice here we're only looking at operating activities. The bottom line is that we're going to get the same final answer. The net cash provided by operating activities in both cases is $20,000. But what you can see here is the direct method. We are only concentrating on what actually happened in the cash account. So the cash flows from operations are going to be cash received from customers, cash paid for merchandise, cash paid for wages, cash paid for interest, and cash paid for taxes. It's a fairly straightforward and simple way to look at things. But the truth is what investors and people really want to know is, I know what your net income number was, but what I want to understand is why does your net income and your change in cash differ? So let's look at how the indirect method tells us that. what the indirect method does is it takes our net income number and it takes adjustments for all of the items that are in net income and adjust those for all of the cash type transactions. So let's look at this. If we want to adjust net income to reconcile to our cash from operations, what we'll do is we'll look at our little cheat sheet that helps you understand how to do this. But we've already looked at this a little bit on the previous slide. But we'll take our balance sheet and we'll look at changes in accounts. So you can see here, this tells us we had an increase in accounts receivable. You can look at this in two ways. You can look at it by first looking at the overall accounting transaction and remembering you have to balance. So let's look at this. If accounts receivable increased, that means we have an asset increasing. If we want to net that out, that means cash would have to decrease because we have one asset increasing, the other one decreasing. So an increase in accounts receivable needs to be shown as a decrease in the operating sections on the statement of cash flows. So you can think of it in terms of making sure that our accounting equation balances. Let's look at another example. An increase in merchandise inventory. So that's an asset. If one asset increases, cash would have to decrease. So we'll show that here. But let's look down here. We had a decrease in a liability. So we're moving to that other side of the accounting equation. Remember, assets equals liabilities plus equity. So if something on the other side of the equation decreases, to make sure that our equation always holds true, that would mean that something on the asset side would also have to decrease. So in this case, a decrease in accounts payable is going to be a decrease on the statement of cash flows. So again, you're making sure that you're always balancing. Let's look over here. If we have an increase in income taxes payable, okay, income taxes payable is a liability. So if something on the right side of the equation increases, you're going to need to show that as an increase in the statement of cash flows because you also need an increase on the other side of the equation. So an increase in income taxes payable is going to be shown as an increase in the operating section of the statement of cash flows. Another way you can look at this is think about the effect of net income and cash. So again, we can do this the same way. If we have an increase in accounts receivable, what does that mean happened? If we are taking in accounts receivable, that means we made some type of revenue or someone owes us some type of money. So that revenue would be reflected in this net income number. But remember, we're not doing an income statement. We're doing a statement of cash flows. So if we earned revenue, but we got accounts receivable rather than cash, this means that we did not get this amount in revenue. It means that we did get revenue, but we didn't get cash. So we need to reduce our income for the amount of cash that we did not get, because remember, this is the statement of cash flows. The same thing if we have an increase in merchandise inventory. This increase in merchandise inventory means that we bought something. And if we bought something, we paid cash. If we didn't pay cash, you'll see an increase in your accounts payable down below. But in this case, we're going to assume we paid cash. So an increase in inventory is going to have a negative effect because it's going to be a decrease. So this is inventory that we have purchased. We have not yet sold it. So it's going to be shown as a negative item. So let's begin looking at how we actually calculate these, and we'll go through them step by step. So here's some of the information that we need. You can see here we have our comparative balance sheet. And what we've done is we've gone ahead and looked here. Cash changed from a $12,000 balance to a $17,000 balance over the year. So we had a $5,000 increase. Accounts receivable increased by $20,000. Inventory increased by $14,000, and so on. So we're looking at all of our various changes. And then here we have our income statement. The income statement is important because we need this net income number, But we're also going to need any information on if we had any type of non-cash expenses, for example, depreciation and amortization, which in this case we don't have. But we'll also need to know if we had any types of gains or losses. So again, we'll adjust for those as we move forward. So here, this is just kind of what we're looking at. We've got some basic additional information. So all of these are things that you can read through on your own or in the book. If we go through them step by step, just here in the lecture, it could get overwhelming. So we're just going to go over the overall idea. So to apply this indirect method of reporting, we're going to start with net income. And then we're going to make adjustments as necessary. So first, you want to look at any non-cash expenses such as depreciation and amortization. And you will add these back to net income. And let's think about why. Net income is going to include both cash and non-cash transactions. Depreciation and amortization, these are non-cash expenses. So we need to add them back to net income because these are expenses that are reducing net income, but they aren't really a reduction in cash. So we add those back to take out their effect. We'll do the same thing at the end with any losses and gains. We add back any losses and we'll subtract any gains because, again, these are not cash transactions. So we need to get rid of the effect of a loss by adding it back, the same thing that we did with our non-cash expenses. And then any gains, we'll need to subtract them to get rid of their positive effect on net income because, again, this has a positive effect on net income, but it is not a cash transaction. And we'll need to calculate any changes in non-cash current assets and current liabilities. And that's what we were looking at when we were looking at the change in accounts receivable, the change in inventory, or accounts payable. And we'll look at how those affect our net income. So let's move forward, and here's the little cheat sheet that's going to be helpful. I think it's best to understand how these work, where I was talking about you need to understand that if accounts receivable increased, that means you earned revenue, but you didn't get cash, so that would be a negative effect on the overall statement of cash flows. But we also have a little cheat sheet here that you can use. So what we're looking at is the change in an account balance during the year. You're looking at whether that balance increased or decreased. If it's a current asset account, so for example, if it's accounts receivable, if accounts receivable increased, we'll subtract that increase from net income to bring us to the cash transactions. Then if it was a decrease, we add that to net income. So if accounts receivable decreased, that means we got cash. We didn't necessarily earn it right now. We had earned it at some point in the future or in the past, but now we're actually getting the cash because accounts receivable decreased. So we would add that to net income because it's revenue that we didn't actually earn right now, so it wouldn't be showing in that net income number, but we are receiving the cash. And what are we trying to do? We're trying to make our statement of cash flows. Then with our current liabilities, we'll add an increase because that means we had some type of expense that we didn't pay in cash right now. So we would need to increase net income for that amount. And then if we have a decrease in a current liability, we'll subtract that from net income. An example would be accounts payable. That if we see a decrease in accounts payable, that means we paid cash for some type of expense that we had incurred in the future, in the past. So even though that past expense is not in our current income number, it is going to be a decrease in cash. So that's why we subtract that from net income. So you can use this table as a little bit of a cheat sheet to help you learn how to do all of this. So here we have our net income number, $38,000, and we'll need to make any adjustments to get our operating activities to show our actual cash effect. So here, depreciation expense is going to be added back because, again, this is an expense that is reflected in the income number, but it is not a cash transaction. So we need to take out the negative effect that it has on net income by adding it back. And then if we have any losses, we also add those back to take out the negative effect that they had on income, because although they have a negative effect to income, it's not a cash transaction. So we add that back. And then the same is true with the gain. A gain has a positive effect on net income, but it's not a cash transaction. So since it has a positive effect on net income, we need to take it out to get rid of that positive effect. So basically what we're doing is netting out any of these non-cash items from the net income number. And then we'll move into reconciling any adjustments based on changes in these current assets or current liability accounts. You can use your cheat sheet, but you can see here if we have an increase in accounts receivable, we show that as a decrease to our net income number. An increase in inventory, again, is a decrease. An increase in any type of prepaid expenses, remember these are an asset, so an increase in this current asset is going to be a decrease to net income to get to that cash flows from operations. Then let's move into our liabilities. A decrease in accounts payable is a decrease to our net income number. A decrease in interest payable is going to be shown as a subtraction again. But then if we have an increase in one of our current liabilities, that's going to show as an increase when we adjust our income number to get to our cash flows from operations. So let's put all of that together. We have our net income number, adjust for any of our non-cash items, and then we have our calculations for changes in our current assets and current liabilities. And that gives us our net cash provided from operating activities of $20,000. So what this is telling us is although we earned net income of $38,000, that included some non-cash items. So when we adjust for all of those non-cash items, and then we adjust for changes in current assets and current liabilities, we see that from our operating activities, we actually brought in cash of $20,000. So we're reconciling this $18,000 difference between our net income and our cash provided by operating activities. And so again, we just have a little bit of a cheat sheet here for you, and this is just for that section for your operating activities. So let's go over the basic idea here now because we've gone over it in detail already. So you'll begin with your net income number. And the bottom line is that we're going to reconcile the difference between net income and then the cash provided, or if we used more money than we brought in, it would be the cash used by operations. So how do we do that? First, we need to adjust for any items that are in this income or loss item, or this dollar amount here, that are not actually cash items. So these are going to be our non-cash expenses and losses and our non-cash revenue or gains. So if you have an expense or a loss, that means that is a negative item in the income statement, but it is not a cash item. So we add that back to bring this effect to nothing. The same with our revenues and gains. If it is a non-cash revenue or gain, it means it is a positive or an increase item in the income number. So to net that non-cash item to zero, we would then subtract it. So we get rid of the effect of these non-cash items because they were already in the income statement number. We get rid of them, and that brings us one step to reconciling between income and operations. Then we need to make adjustments for any changes in our current assets or current liabilities. So you will add a decrease in your non-cash current operating assets, subtract an increase in your non-cash current operating assets, add an increase in your operating liabilities, current operating liabilities, or subtract a decrease in those current operating liabilities. And then, if we have done everything properly, we should be able to reconcile. All right, so let's keep moving forward. We're now going to look at cash flows from investing and financing. These are going to be a little bit more straightforward and less time-consuming. So first, we'll look at investing. Again, investing items are those things that you have done to invest in your company, whether you're investing your money in some type of long-term investment or if you've purchased property, plant, and equipment that you're hoping will end up being a return on your investment by bringing in revenue from using those assets. So we have a 3-stage process, and this is the same process that we'll use for financing. First, we're going to look at our balance sheet and identify the changes, the year-over-year changes in the investing-related accounts. So we'll look at what those accounts are when we look at the balance sheet in a second. We need to explain what made those changes, and then we'll report the items in those changes that had a cash effect. So let's look at this. We've got our balance sheet again, and let's look at our investing items. Remember, investments are somewhere that we are investing our money, hoping for a long-term gain or return. So what you can see here is one of the most obvious areas would be any type of activity within your long-term assets. And what we see here is our plant assets decreased by $40,000, and our accumulated depreciation, I'm looking at this backwards. I totally confused you. All right, we're looking, here's 2014, 2015. So instead, we increased our plant assets by $40,000, and we increased our depreciation, our accumulated depreciation, by $12,000. But it's not that straightforward. We have to then look at our additional given information to understand why did we increase in our plant assets, because there could be multiple things that happened within this one line item. So then we'll go to our information. If you go back to the beginning given information, you can see here that the company purchased plant assets valued at $60,000 by issuing $60,000 in notes payable. So what they're telling us is part of this increase is due to the purchase of additional plant assets. However, you can see we purchased plant assets for $60,000, but our increase here, the overall balance, is only an increase of $40,000. So that what that means is there's more going on, because we bought additional plant assets for $60,000, but the increase is not for $60,000, it's only $40,000. So that means something must have also reduced it. Most likely we sold something, but we've got to look at that. But some more information is, how did we purchase this? We issued notes payable. So is this a cash transaction? We increased plant assets and we increased a liability. We did not pay cash. So this is a non-cash investing transaction. So this actually will not go on the statement of cash flows. It'll go as a note at the bottom of statement of cash flows, or just a note to your statement of cash flows in the notes to your financial statements. So then let's look at our other given information. Okay, we're told that the company also sold plant assets. Okay, so now you can see we bought $60,000 worth of assets, but we sold $20,000. So the net effect there is that $40,000 overall increase that we're seeing. So now that we understand what all's going on, we need to understand what happened when we sold this. We sold these, and they had $12,000 of accumulated depreciation, and then we got $2,000 worth of cash, and we had a loss. So let's go ahead and look at what that transaction would have looked like. We got cash of $2,000, but then we have to take all the accumulated depreciation off of the books. So accumulated depreciation related to that, we're told here, was $12,000. So we've got to take that off of the books when we sell the asset. This is back, we studied how to do this a couple chapters back. And then we had a loss. The loss was a $6,000 loss. And then we reduced plant assets by the full amount. So let's look. There's only one item here that has a cash effect, and that's that we received cash of $2,000. So with all of this activity that happened, all we're going to see is $2,000 on the statement of cash flows. We'll have some notes to explain what else went on, but this is the only cash effect. Then we can look at over here. Keep in mind that we had some activity within accumulated depreciation. Accumulated depreciation increased by $60,000. And now we can see that there's two things, it did not increase by $60,000. It increased to $60,000 from $48,000. So we had an increase of $12,000. So what happened here? You can see here that when we sold this asset, we would have decreased accumulated depreciation by $12,000. But also we have additional depreciation for the current year, And we're told that for the current year, we've got $24,000 of accumulated depreciation or depreciation expense. So our depreciation expense is $24,000. Our accumulated depreciation then increases by $24,000. So this increase of $24,000 and decrease of $12,000, that's what we're seeing over here as that overall increase of only $12,000, because the two of those, this activity, ends up netting to an overall increase of $12,000. So that's what happened in our investing activities. Now let's look at cash flows from financing. Same thing, we're going to look at the change in our accounts. We're going to reconstruct what all made up those changes, and then we'll report their cash effects. So what you can see here, we first need to identify any accounts that relate to cash flows or financing activities. So anything within long-term notes payable, this would be a financing activity, and then really anything within this common stock or retained earnings. Those are financing type of activities. So let's look here. What do we see? We see an increase in our notes payable. It went from $64,000 to $90,000. So what happened there? You can see here that notes with a carrying value of $34,000 were retired for $18,000, resulting in a $16,000 gain. So let's go back here. You can see here that long-term notes payable actually increased. So what we're seeing here is a decrease in notes payable. So that tells us more must be going on. But first, let's go ahead and look at the cash effect here. So we decreased notes payable by $34,000, and the way we did that was we went ahead and we paid cash. That was cash of $18,000. That's going to be going out the door. Cash going out. That would be part of the cash flows on your on the financing section of your cash flow statement. And we also had a gain on the retirement of debt because we paid this debt off early. So that gain is $16,000. But there must be some more things going on here. We are told we issued 3,000 shares of common stock at par, $5 per share. So you can see here cash of $15,000. We got cash. We issued common stock. So here's some cash effect from financing activities. And then we paid cash dividends. You can see here we paid cash dividends of $14,000. So retained earnings decreases by the amount of those dividends. And then our cash also decreases by that $14,000. So here you can see we just have our ending balances, the net increase in cash, and that's just going to be the sum of the $20,000 from operations, the $2,000 from investing, and then the $17,000 effect from financing activities. So you can see here the overall net increase from our statement of cash flows is $5,000. We can check our work. Does that agree with the change in the cash account on our balance sheet? Our cash account went from $12,000 to $17,000, meaning that our cash account increased by $5,000, and that does agree with what we came up on our statement of cash flows. So here we just have an overall summary of everything that went on. I'm not going to go over this in full, but you can see here we have our net income number. We add back all of these non-cash items, and then we have our various adjustments. Let's look here, for example, accounts receivable. Remember the change in accounts receivable, that's going to be an operating type of activity. And you can see here that accounts receivable increased by $20, or I believe it was really $20,000. We're just doing this at 20. So you can see here, based on our rules of making sure everything balances, this increase is a debit. So we would expect to see this on the credit side of cash. So an increase in accounts receivable is going to have a negative cash effect. So that would be a negative or a decrease in the operating section in the indirect method of our statement of cash flows. But again, this is just a summary that you can look over on your own to help you again understand how all of this works. So let's look at our basic cash flow analysis. We use the statement of cash flows to understand what's going on with our cash. It helps us to understand how we're spending our money, how effectively we're using it, and even more importantly, it helps us predict cash flows for business decisions. And what I mean there is, are we going to have enough cash to finance our business in the coming years? If it looks like we're not, we'll need to step in and either go out and look into some type of financing, begin working with banks to borrow money, or begin looking at equity transactions. Are we going to sell additional stock, or what's going to go on there? So it helps us to plan. Here you can see an example of what we're looking at for different companies. So you can look and you can see here cash provided by operations. These first two companies actually brought in cash from their basic operations. So they're bringing in income here based on their operations. This third company here is actually spending money. They're spending more money in operations than they're actually bringing in. And while that looks bad, it's really not uncommon. So typically you're going to see a negative or cash used by operating activities. Really for any new company, they're typically spending more money to get started than they're actually bringing in. And that's why you can also see here, where is their cash coming from? It's being provided here in investing and financing activities. Commonly this is going to be seen at the beginning stages of a company. Then you can see over here, these two companies, they're actually bringing in money from their operations. And you can see here, they're most likely, you can see the negative impact here from investments. So they're investing their money in their company. They're investing money, whether it's in property, plant, and equipment, or some type of financial investment to get a return in the future. You can see here also this first company, they're bringing in a lot of money from their operations. They're spending some of that money, and then with any excess they have here, they're paying off some debt. The bottom line here is that when you compare these three companies, they're all actually seeing the same overall increase in cash, but there's a lot of things going on, and you're getting an understanding of how they're spending and using money based on the changes within each category, whether they're making or using money from operations. Are they investing in their company? Are they in a place where they're borrowing money? Or are they paying it off? So it gives us a picture of what's going on with a company. We're going to end the chapter with just another basic ratio, and this is the cash flow on total assets. It's a pretty simple ratio. All we do is we take our operating cash flows, so that first section of our statement of cash flows from operations, and divide that by our average total assets. What we're doing here is saying, based on all the investments we've made in our company, so our average total assets, that's going to include both current and long-term assets, what are we doing with those assets? Are we actually producing positive operating cash flows? Because the bottom line is that although net income is important, if a company doesn't have the cash on hand, if they're not producing cash from their operations, eventually they will run out of resources in order to carry out their business. So although you can have positive net income with negative operating cash flows, that can't carry on forever, because eventually your sources of financing would run out. People would quit loaning money. Banks would no longer be loaning you money. And then your investors would no longer be interested in investing their money or purchasing the stock of a company that cannot produce operating cash flows. So it gives us an understanding of what are we doing with our investments? What are we doing with the money that we're spending on the overall assets of the company? Are we actually producing operating cash flows? And it gives us an idea of the riskiness or the stability of the company. So that's the cash flow on total assets ratio.